Harry just made a $847,000 mistake, and he doesn't even know it yet. See, Harry's sitting in his kitchen right now, calculator out, running the numbers for the 100th time. Historical returns show stocks averaged 10.3% since 1926. Bonds? A pathetic 6.1%. It's obvious, Harry mutters to his wife. Why would anyone buy bonds when stocks make so much more? His wife shifts uncomfortably. But what about diversification? What about... Diversification is protection against ignorance, Harry interrupts, quoting Warren Buffett. I know what I'm doing. But here's what Harry doesn't know. In exactly 18 months, his 100% stock portfolio is going to get obliterated. And the decision he makes in that moment of panic will either cost him $847,000 or make him one of the smartest investors alive. The difference? Understanding the one thing financial advisors never tell you about 100% stock portfolios. Because the answer to whether they work isn't about math. It's about psychology, and most people get it catastrophically wrong. Let me show you something that'll flip your understanding upside down. Vanguard data. Going back to 1926 shows that a 100% stock portfolio averaged 10.3% annually. An 80-20 portfolio, 9.8%. A 90-10 portfolio, 10%. So Harry was right, wasn't he? More stocks equals more money. But here's what Harry didn't know. That extra 0.3% to 0.5% annual return? It comes with a price most investors can't afford to pay. In 1931, during the Great Depression, stocks lost 43% in a single year. But that wasn't even the worst part. From 1929 to 1932, the stock market dropped 90% over 4 years. Imagine watching your life savings shrink by 90%. Could you handle it? Could Harry? 2008 arrives. Harry's 100% stock portfolio gets demolished. Down 51% in 18 months. His $400,000 becomes $196,000. Harry's wife finds him staring at his computer screen at 2 a.m. Maybe we should put some money in bonds, she whispers. But Harry remembers the compound interest calculations. This is temporary, he tells her. Stocks always come back. And he was right. By 2013, Harry's portfolio had recovered completely. But here's what he didn't realize. His neighbor Tom, with an 80-20 portfolio, had actually recovered faster with less stress. Tom's max drawdown was only 40%. Tom slept better. Tom's marriage didn't suffer. Tom stayed invested. Harry almost bailed 3 times during those dark months. Now let's fast forward to Harry's retirement in 2020. He's 65 with $1.2 million saved. Time to start withdrawing money for living expenses. This is where 100% stock portfolios get dangerous. Harry plans to withdraw 4% annually, $48,000, adjusted for inflation. Based on historical data, this should be safe, right? Wrong. Here's the brutal truth about retirement planning. It's not about average returns. It's about the sequence in which those returns happen. Portfolio Visualizer shows us something terrifying. If Harry had retired in 2000 with a 100% stock portfolio and a 4% withdrawal rate, he'd be barely surviving today. His portfolio might not even last 30 years. Why? Because he'd be forced to sell stocks during the dot-com crash and the 2008 financial crisis, selling low locks and losses permanently. Meanwhile, a retiree with a 60-40 portfolio starting in 2000? They'd still have money left. But the math isn't even the biggest problem. The real killer is what happens inside your head when you watch your retirement savings get cut in half. Behavioral finance research shows that during market crashes, even smart investors panic. They sell at the bottom. They buy bonds when stocks are cheap. They do exactly the wrong thing at exactly the wrong time. Charlie Munger put it perfectly. If you cannot deal with a market price decline of 50% 2 or 3 times a century, you are not fit to be a common shareholder. Most people aren't fit. During the 2020 COVID crisis, retail investors pulled 9% out of their funds. In 2008, only 4%. We're getting more reactive, not less. Harry thought he was different. He thought he could handle the volatility. But when his portfolio value dropped from $1.2 million to $600,000 in 6 weeks during March 2020, he called his broker at 3 a.m. "Get me out," he said. "Put everything in cash." Fortunately, his broker talked him down. But millions of investors weren't so lucky. So is a 100% stock portfolio ever a good idea? Yes, but only in very specific circumstances. For accumulation, when you're still working and adding money regularly, the data is compelling. Dollar cost averaging into stocks during market downturns can be incredibly powerful. When the Nasdaq crashed 75% from 2000 to 2002, investors who kept buying were getting shares at fire sale prices. By 2007, they'd made fortunes. If you're under 40 and investing steadily, 100% stocks can make you rich, but only if you keep buying while everyone else is screaming on the news. But you need three things: time diversification, at least 20 years before retirement; steady contributions that continue during crashes; iron nerves to keep buying when everyone else is selling. Harry had 2 out of 3. His nerves almost failed him multiple times. Here's where Harry got smarter. Most 100% stock investors suffer from home country bias. They put everything in US stocks because that's what feels safe. But American equities represent less than half of global market capitalization. By ignoring international stocks, you're missing massive opportunities. Harry restructured his asset allocation: 60% US total market, 25% international developed markets, 10% emerging markets, 5% REITs. This wasn't just about diversification. Academic research shows that international equity diversification can increase returns by 34% while reducing volatility. When US large caps struggled in the 2000s, international stocks and emerging markets picked up the slack. Harry's portfolio performance improved dramatically. But retirement changes everything. Bill Bengen's original 4% rule research wasn't based on 100% stocks. It used a 50-50 portfolio of stocks and intermediate-term treasuries. Why? Because bonds provide a crucial buffer during market downturns. Instead of selling stocks at fire sale prices, retirees can live off bond income while waiting for stock prices to recover. Javier Estrada's research offers an intriguing alternative. His data suggests 100% stocks might actually be optimal for retirement, but only if you can psychologically handle the roller coaster. Most people can't. Estrada found that while 100% equity portfolios had the lowest failure rates in Monte Carlo simulations, they're unlikely to be appropriate for most retirees due to their extreme volatility. The compromise? A declining equity glide path. Start retirement at 80% stocks, gradually shifting to 60% or 50% as you age. But here's where it gets really interesting. Some academic research suggests doing the opposite, starting retirement conservative and getting more aggressive over time. Why would this work? Sequence of returns risk. If markets crash early in retirement, you're protected by bonds. If markets recover later, your increasing stock allocation lets you benefit more from the gains. It sounds backwards, but rising equity glide paths can actually reduce both the probability and magnitude of portfolio failure. So what did Harry choose? After 15 years of 100% stocks during accumulation, Harry shifted to 80% stocks and 20% bonds for retirement. I learned something about myself, Harry said. I can handle volatility when I'm adding money. But when I'm taking money out, that's different. Harry's compromise gives him most of the growth potential of stocks while providing a psychological buffer against crashes. His expected returns dropped slightly, but his peace of mind improved dramatically. And that might be worth more than any extra percentage points. Here's the bottom line. 100% stock portfolios can work during accumulation if you have decades to invest and the emotional fortitude to buy during crashes. The historical data supports higher long-term returns, but for retirement, the picture gets murky. While 100% stocks might offer the highest average returns, they also carry the highest risk of catastrophic failure due to sequence of returns risk. Financial institutions like Vanguard and Morningstar generally recommend balanced portfolios for good reason. It's not that they're conservative, it's that they understand human nature. Most investors make emotional decisions during market volatility. They sell low and buy high. They abandon perfectly good strategies at exactly the wrong time. A 60-40 portfolio or 80-20 portfolio might deliver slightly lower returns, but it's much easier to stick with during tough times. And a strategy you can stick with will always beat a strategy you abandon. Before you decide on asset allocation, ask yourself these questions. Can you handle watching your portfolio value drop 50% without panicking? Can you keep adding money during bear markets when everyone else is selling? Do you have at least 20 years before you need the money? If you answered yes to all three, 100% stocks might work for you during accumulation. If you're in or near retirement, the calculus changes completely. Sequence of returns risk becomes your biggest enemy, and bonds become your best friend. Harry learned this lesson the hard way. Don't let your emotions sabotage your financial future. Want to see exactly how different portfolio allocations perform over various time periods? Click here to access our portfolio analysis tool and run your own scenarios. And if you found this analysis helpful, hit that like button and subscribe. Next week, we're diving into withdrawal strategies that can make any portfolio last longer in retirement. Remember, the best investment strategy isn't the one with the highest returns on paper. It's the one you can actually stick with when markets get ugly.